Good morning, everyone, and welcome to our second webinar on OBA, or the One Big Beautiful Bill Act, in which we will be focusing today on the business side of the bill. We received a lot of positive feedback from our webinar yesterday, so we encourage you to continue to reach out to us and let us know what you think, and if you would like us to continue these webinars in the future, and even if there are any specific topics that you might be interested in learning about, and we'll go ahead and put those together for you. We're honored once again that you took time out of your busy schedules as business owners to be here with us today, and hope it proves to be informative and gets you thinking about how these new changes can possibly impact your business from a tax or even operational point of view. We're once again joined by the entire HLA tax team. We have Carl and Byron joining me to talk about the various aspects of the bill, and we have Kieran and Amber monitoring the chat for your questions for the Q&A portion at the end of our presentation. So for those of you who are with us yesterday, I apologize if you have to hear this again, but let's start with an introduction on what OBA is. So at 870 pages long, OBA, or the One Big Beautiful Bill Act, is a comprehensive piece of legislation passed by Congress and signed into law on July 4th. An early version of the bill was initially passed by the House on May 22nd by a 215 to 214 vote, and was received and amended by the Senate and passed with a 51 to 50 vote. That amended bill was then sent back to the House, and the final version was passed on July 3rd and was signed into law by President Trump on July 4th. The comprehensive bill includes provisions related to individual and business taxes, healthcare, immigration reform, and employment issues. However, like I said, we will only be focusing today on the tax impact on businesses. And although there's a lot in this bill that applies to businesses, we feel like there are essentially four major ones that we'll be focusing on the most today. And those will be related to the QBI deduction, bonus depreciation and 179 expensing, 1099 reporting changes, and research and development expensing. So let's begin by talking about Section 199A, or the QBI deduction. Now, I'm going to warn you in advance, this is a complicated area, and it's probably something that we could spend a 2-hour webinar going through all the ins and outs, but I'm going to do my best to explain it in about 5 minutes. And the reason why I thought it was important is that I'm not sure how many business owners are aware of this deduction and of how it's calculated and whether or not they actually qualify for it. So I'm going to do my best to walk you through this right now. And my goal is, I see we have 35 attendees currently. My goal is not to lose any of you in this next 5 minutes. So that's my goal. So what is the Section 199A, or QBI deduction? Well, this was put into law back in 2017 to counteract the permanent 21% tax rate on C corporations from the Tax Cuts and Jobs Act. So prior to this, if you remember back, a lot of business owners were complaining that their tax rates were too high and that they couldn't be competitive on the global market. So as part of the TCJA, they permanently reduced the C Corp taxes down to 21%. Well, that left a lot of other businesses and small business owners at tax rates that could potentially be higher than that, because they were pass-through entities and they were paying tax on the income based on their personal tax rate. So what Congress did was they enacted this Section 199A, also known as the QBI deduction. And the deduction is taken on the individual's return. It's not taken on the business return. And this applies only to owners of S corporations, partners and partnerships, or if you're a sole proprietor, some estates and trusts as well. So any type of tax return where the business's net income flows through to the 1040 income of the individual, those are the ones that qualify for this. So for any of you that have C corporations out there, you can go take an early coffee break and just sit back and relax for now. like I mentioned, the calculation is complicated, so I'm going to try to go over this as best as possible. The deduction itself is based off of what's called qualified business income, which is essentially just the net profit of the business. On the individual level, so on your personal tax return, you're looking at the deduction being the lesser of 20% of what's called the combined qualified business income, or 20% of the individual's taxable income, less any net capital gains that you might have. So that's the calculation just on the personal return. In order to find out what the combined qualified business income is, you have to go to the business return. And for that, it's either going to be 20% of your qualified business income or 20% of your net income, or in certain circumstances, the greater of 50% of all W-2 wages paid, or 25% of W-2 wages paid, plus 2.5% of what's called unadjusted basis of qualified property. Again, I don't want to get into all the technical issues with this calculation, but it is, like I said, a complicated calculation that is done on the business side of the return. For 2024, so the most recent tax year that we've had, the wage calculation part, so the part that's pertaining to the W-2 wages, does not apply if the individual's 1040 taxable income is less than $383,900 if you file jointly, or $191,950 if you're filing any other way. So if you're below those income amounts on your personal return, you're essentially just taking either 20% of the business net income or 20% of your personal taxable income less the capital gains. So just want to go through a quick example to put some numbers into what we just talked about. So if you're a 100% owner of an S corporation that provides consulting to other businesses, you're married, you have individual taxable income on your 1040 of 300,000, so 250,000 of that's from your S corp, and you have no capital gains. So your QBI calculation will be the lesser of your QBI, or 20% of your S corp income, which is 50,000, or 20% of your taxable income minus capital gains. Well, we don't have any capital gains, so 20% of your taxable income is going to be 60,000. So the deduction that you're allowed to take on your 1040 is going to be $50,000. So essentially your S corp made 250,000, but you're really only paying tax on 200,000. So that's essentially how the QBI deduction works. Now, what if you're above those income limits, above the 383,900 or 191,950? Well, that's when it gets tricky, because then we have to look at what type of business are you. And if you're considered what's called a specified service trader business, which you can see on the screen, all the different fields that fall under that category, but it's essentially any type of business where the principal asset of the business is the reputation or skill of the individuals within the business. So you're not really selling any type of product. It's based off of essentially service businesses. Now, there were some specific industries that were exempted from that definition. So we see, what industries had the biggest lobbying budgets, pretty much. So there were some that were exempted from that. Now, if you are an SSTB and your income exceeded those limits, the 383,900 or the 191,950, then just note that there is a gradual phase out of the amount of credit that you could be eligible for. And then once you exceed the top phase out amount of 483,900 and you're an SSTB, you don't get any of the deduction at all. Now, if you're not an SSTB, then that's when you go back and do the calculation based off of the W-2 wages and things like that. Let's go over another example. So this is an example of someone that is over the income levels, but you'll see how what type of industry you're in makes a huge difference. So we have a manufacturing company that's owned 100% by one married individual. It has QBI of 500,000. So the company has profit of 500,000. They paid company wages of 1 million. They had $100,000 of unadjusted basis, and individually, the owner has taxable income of $550,000. So because he's over the income level, we have to first go to the combined QBI calculation. So 20% of the taxpayer's QBI, or 20% of the business net income, is going to be $100,000. Then we look at the greater of 50% of wages paid, which is $500,000, or 25% of wages paid plus 2.5% of the unadjusted basis. That comes out to the $252,500. So the greater of the two is $500,000, but then we compare that to the lesser of that number, or 20% of the QBI, which is $100,000. So the QBI deduction now on the individual's return becomes the smaller of that $100,000, or the 20% of the taxable income minus capital gains, which is going to be $110,000. So the individual, because they're a manufacturing company, they're not considered an SSTB, they're eligible to get the full $100,000 deduction, despite the fact that their income's over the threshold. If we change this example and move it from a manufacturing company to a law firm, then there is no deduction allowed because they're an SSTB and they're over that income threshold. So those were the laws that were in place before 2025. So what changed when OBA got passed? Well, 199A was set to expire at the end of 2025, so that 20% deduction was going to go away. OBA made the 20% deduction now permanent. And one of the earlier versions of the tax bill that passed the House did actually have an increase of that amount to 23%, but that did not make it through the Senate bill. And so what we ultimately ended up with is just the 20% deduction. The income thresholds have been raised as well, from $383,900 for married filing jointly to $394,000 for married filing jointly. What also increased were the phase-out thresholds for the wage and property limitations. So those increased by $150,000 for married filing jointly, or $75,000 if you file otherwise. So essentially, just what all that means is more individuals may now be eligible to qualify for the QBI, especially those that have specialized service businesses that maybe prior to 2025, they weren't qualifying. Now there's a better chance that they will qualify to get this deduction. The other thing that changed and that was new for this year was there's now a new minimum $400 deduction as long as you have at least $1,000 of QBI and you materially participate in the business. And that $400 that's the minimum. So if you have $1,000 and 20% of the 1,000 is only $200, you still get the $400. And in order to determine whether or not you have material participation, there's it's essentially 7 tests that the IRS has. It's mostly based off of the time that you're spending on the activity and what your individual involvement is within that activity. So just to summarize, for 2025 under OBA, a married couple filing jointly that has taxable income less than or equal to $394,600, you get the full QBI deduction, whether you're an SSTB or not. So that's just an automatic, you get the 20%. If your income's more than $394,600, but less than $544,600, because that's the new thresholds, your QBI may be gradually phased out. And there's a complicated calculation that goes into that as well. And if your income's over $544,600, you're over the phase out. So if you're an SSTB, you don't get a deduction. If you're a non-SSTB, that's where we go back and have to do the calculation that's based off of the wages and the unadjusted basis. So I didn't lose anyone. I did my job there. That's QBI in a nutshell. Obviously, very complicated area. So, you know, if you have any questions specifically related to your business, then feel free to contact us about that. Next, we want to move on to talking about bonus depreciation and Section 179 expensing. And Carl, I believe you are taking this portion of the presentation.
All right. All right, some good news on the depreciation front. Um, the bonus depreciation has been gradually phased down, was supposed to be 40% this year, and it was increased to 100%. So if we have items that we want to bonus depreciate, we get the full 100,000 versus the 40% that it was supposed to be. We also have some changes to the 179, which is sort of similar to bonus, where that has increased from $1 million to 2.5 million for assets purchased. So I guess looking at this bonus depreciation that's available, and then the 179 that's available, what's the best move to make? Do we take the bonus depreciation, or do we take the 179? And it's going to be a little bit different, the advantages and disadvantages for an individual that's self-employed or has real estate, or someone who has a C corporation, because C corporations pay their own tax. The advantage of the bonus depreciation is that you get the full amount. You can't say I only want to take half of the bonus depreciation. It's either all or nothing. And also, if you've purchased multiple assets during the year, let's say you've purchased 7 different assets that are all 5-year assets, then you have to take bonus for all of those. You can't say I'm only going to take it on 3. You have to take it on all of them. For 179, you have the ability to select what assets that you want to take and how much you want to take. So if you purchase an asset for $100,000 and you bonus depreciation, you're taking the full 100,000. For 179, you can say, I only want to take 20,000 or 25,000, or you have this, you can take either the regular depreciation on that vehicle or that asset of 20% the first year, or you could say, I want to take 80,000 of it and then depreciate the balance of that over the 5-year period. So you have a little bit more control on the 179 than you do on the bonus. The advantage of the bonus is that you can generate a loss. So there's no limitation there. If you have assets in a Schedule C and you want to generate a loss because you have another entity that you have a gain in, and you want to have the Schedule C offset the income from either another Schedule C or a partnership or an S corporation, you can do that. 179, you can't. You cannot show a loss from a 179 deduction. In a corporation, that's an advantage because the law changed in 2022 for corporations. And it used to be that if you had a loss, let's say of $80,000 in 2024, and now you have a profit of $100,000 in 2025, you could have taken that full loss against it. But now what happens is that you only can take a loss up to 80%. Well, that was bad numbers. Let's say you had a loss of 90,000 and a profit of 100,000, so that 80,000 of that loss in 2024 can offset your income in 2025, not the full amount. So the way around this is that we're not as interested in showing losses on the C corporation because we're limited taking those losses going forward. If you take a 179 election, what happens is when you get to the point where you're at zero, those deductions that are there just carry forward. So we had a loss of 80,000. We also bought $50,000 worth of equipment. If we had bonus that, our loss would have been going from 80 to another 50 would have been 130. But if we take the 179, those deductions stay in the system in your return and carry forward. So the next year when you made $100,000, I can still use the loss, but I also have the 179 that'll drop in and reduce that. So that's one of the advantages of on a C corporation starting to look at a 179 versus bonus depreciation. If you're a Maryland taxpayer, there's what's called a decoupling, and the decoupling, you get the first 25,000 of 179 deduction. You don't get anything for the bonus. So if you had identical returns here, and we said we have a profit of $25,000, well, and we bought $25,000 worth of assets, if we bonus that, we'd still have to pay Maryland tax because of the decoupling. If we 179 it, we would get to $25,000 first exclusion and not pay any Maryland tax. So there's some planning that goes on here with going forward as, do we take the bonus depreciation or we take the 179, and looking at, again, everything else going on in the return and looking at what's going forward, is to determine, do we want to take this full loss on the property that we've purchased, or do we want to control it by doing the 179? So that's the big changes on the depreciation going forward, with the increase going from $1 million to 2.5 million, and the bonus going from 40% to 100%.
All right, thank you, Carl. The next section we're going to talk about, I think, is going to be very popular with a lot of bookkeepers and maybe payroll companies, and that is that there are some pretty significant and well-deserved changes when it comes to 1099 reporting. So under the previous law, as everyone knows, businesses were required to file a Form 1099 miscellaneous or 1099 for non-employee compensation for payments of $600 or more in a taxable year to any non-corporate recipient. OBA, however, has changed that threshold from $600 to $2,000 made in years beginning after 12/31/25. And that's going to be adjusted starting in 2027. So this change does not apply to this year. So we are still under the previous $600 limitation for this year, but starting next year, you do not have to issue 1099s if the payments are less than $2,000 within the calendar year. So this is going to significantly reduce the number of 1099s that you're going to have to file, and a lot of probably the bookkeeping requirements or record keeping requirements as well. Now for the 1099K, so these are those third-party forms that you get when payments are being processed through a third-party settlement organization like Venmo or Zelle, or online marketplaces like eBay. As you know, they sent out 1099Ks for the past several years. So what OBA did was it returned back to the old law prior to 2021 that they no longer have to issue a 1099K unless it's for more than $20,000 and 200 transactions. So both requirements need to be met in order to receive a 1099K. So again, this is going to be hugely beneficial. It's going to be less reporting for small businesses, for those gig businesses. But again, keep in mind, this is for next year, not for this year. The next area I want to talk about is research and development expensing and the changes there. So research and development, or R&D, that typically applies to life science companies and technology companies, but really any company engaged in developing new products and processes, improving existing ones, building prototypes, software development, engineering work, or having new technologies could potentially have research and development expenses. Now, since 2022, companies have been required to actually capitalize these costs and amortize them over 5 years if it's for domestic R&D, or 15 years for international R&D. And this provided a huge cash flow strain especially for small startup technology companies, where they would have this expenditure, and if they're very research driven, so they had this huge cash expenditure, but they weren't getting the tax deduction. So they could very easily have been showing profit and maybe didn't have the funds to pay the taxes on those profits because they were having to amortize all these expenses. OBA reinstated the immediate expensing for domestic R&D starting after 2024. So if you're a small business, which means you have under $31 million in average annual gross receipts over the past 3 years, you can actually retroactively apply this law all the way back to 2022 by amending your 22, 23, and possibly 24 tax returns if you've already filed 24. Other companies, whether you're small or large, also have an option of taking all of those unamortized deductions that you haven't deducted over those years and doing sort of like a 1 year or 2 year catch up. So you can either take all those costs and deduct them 100% in 2025, or you can spread it out over a 2-year period. You get to make that election. Just want to keep in mind that foreign R&D still requires a 15-year amortization, which was essentially put in place to incentivize businesses to put more of their research and development here in the United States to get that more immediate tax write-off. And there are some strategies involved in this new law. Going back to if you're a small business and you have R&D expenses, and let's just say that you're a pass-through entity, you're an S corporation or a partnership. Well, going back and amending tax returns back to 2022 might not be ideal because we're talking about then also amending a lot of individuals' tax returns. And if you have, a lot of these life science companies have a ton of investors and owners that would become basically a nightmare going back and amending all those returns and having the IRS having to approve all those returns. So it may be in most companies' best interest to just do the catch up in 2025. You've already received the deduction for those prior years, do the catch up for this year or spread it out over 2 years and then just continue to expenses going forward. So again, if you have R&D expenses, we'll be talking to you about what we need to do to take advantage of this new provision. Byron, I think you're going to talk about the state and local tax cap.
Yeah, thank you, Brian. So we talked yesterday in the individual session about the increase that has come about with the SALT cap as it relates to the new act. And so I won't necessarily touch base too much on it specifically, but at the very least, the cap goes from 10,000 to now 40,000 beginning this year, 2025. It is a temporary provision. So a keyword being temporary in the sense that after 2029, it will revert back to 10,000. And it is indexed for inflation, 1% per year through 2029, and then the income limitation as well. So all the individual aspects. But from a business perspective, the way, what we at least wanted to talk about today is that the law, the act, I should say, did not impact the restrictions on the pass-through entity tax, and specifically the deductions associated with it. So for those that are not familiar, there is an ability to have your pass-through entity, whether it's an S corp or a partnership, pay the state taxes associated with the S corp or partnership income, and at the entity level, I should say, and then ultimately get a credit on your individual state tax return while also maximizing the federal tax deduction. So where this may come into play, especially as it relates to tax planning, is ultimately there may be a situation that even the 40,000, the increase from 10 to 40, you might not even be able to maximize that depending on if there's a significant amount of income from your pass-through entity or other factors at play. And so for what it's worth, you can take it for those that have taken advantage of it, and certainly those that will continue to take advantage of it. You can maximize this by having the pass-through pay the state tax at the entity level and then getting the additional federal tax deduction, not having that limit at place, not even at 40,000, and then continue on and certainly receive or get the benefit of those tax deductions. And also with the consideration that the SALT cap is only temporary, so 25 through 2029. We want to continue on and obviously maximize those benefits past 2029. And one way to do that is through the pass-through entity tax workaround.
All right. Thank you, Byron.
Mm-hmm.
The next section, just going to touch on this
Hey,
quickly.
Brian,
Yes.
can I just add one thing to what Byron was going
Sure.
over as well? Yesterday in the individual, we were going through a lot of benefits that were there, but they had AGI caps. And so one of the advantages of having the entity, the pass-through entity, pay the tax is it lowers the taxable K1 on the federal return because you've taken that deduction. So for example, when you were going through, Brian, the 199A adjustment and the income restrictions, that by taking this deduction into partnership level or the S corporation level, it's going to lower your AGI and may allow you to take more of a deduction than before. So there's other, the tax laws are like a puzzle or a painting, and you're just trying to work things to get the maximum benefits and the minimum amount of tax. So this is still going to be, even though it's going to reduce the state taxes on the itemized, it is going to lower your AGI income, which has significant benefits in other places.
Yeah. Good point there, Carl. There is a lot of interaction between things in the tax codes that we have to take into account and do various calculations for different scenarios. All right, so like I said, I'm just going to quickly touch on this next section because I'm not sure how many of our clients are currently may qualify for this or are taking this as a something that they're aware of. So first, most energy credits are terminating within the next couple of years, and we talked a lot about that yesterday with a lot of the energy credits on the individual side, but it also applies to businesses as well. And the big one is the one under Section 179D, which used to be known as the Energy Efficient Commercial Buildings Tax Deduction. And this provided a tax deduction based on the cost of energy efficient commercial building property that was being placed into service. And it was the deduction was based off of the amount of square footage that you had. OBA has terminated this deduction for new construction projects or renovations that begin after 6/30/26. So the deduction does remain for projects that were begun before that date. I did see a little bit of contradictory information about that from a couple of different sources. So I did want to try to confirm. Some were saying that the project had to be completed by 6/30/26, but others are saying that it has to be begun by then. So be careful if you're researching this online, that from what I've seen, it is any projects that have started before that date would be eligible. So that for those engineering or construction companies that want to still benefit from this, that may accelerate the timelines on some of these projects, that you may want to bump some of them up to get them started before next June 30th. The next two credits are sort of a little bit related in that they both involve investing in low-income areas. The first one is called the New Markets Tax Credit, and it's a tax credit that, again, it's meant to encourage you to privately invest in what are considered low-income communities by this certain department. It was set to expire at the end of 2025, but OBA has permanently extended that program. The other one, which is probably more well-known, are the opportunity zones. And what this does is it allows investors to defer and potentially exclude capital gains by investing in what are called qualified opportunity zones, which again are low income communities that are established by the state. This was scheduled to sunset after next year, but again, it has been permanently extended, but some of the eligibility requirements have been narrowed. This is great for anyone that has a large capital gain that maybe doesn't qualify to do a 1031 exchange, either because maybe you missed the deadlines for the timeframes for the 1031, or if you have capital gains that weren't from the sale of real estate. If stock sales would qualify for an opportunity zone where they wouldn't for a 1031. So again, just wanted you to be aware that that these exist, especially the opportunity zones, that if you have a large capital gain that you really don't want to pay the tax on, we can explore this as another option to invest those proceeds and get potentially significant tax breaks out of it. It is a little bit of a it's a little bit of a risky proposition because it involves third parties taking those funds and investing them, and then they have to be profitable and things like that. So there is some risk involved in this, but if it works out, it could be a huge tax saver for you. I also just want to briefly touch on some changes to employee benefits. And again, not sure how many clients would benefit from this, but wanted to let you know that there were some changes. So for those employers that are providing childcare for their employees, the credit rate went from 25% to 40%, or if you're considered a small business, it actually went from 50 to 60%, or I'm sorry, it went to 50% for a small business. The maximum credit that you can take went from 150,000 to 500,000, or 600 for an eligible small business. So that's a huge jump for any businesses that are offering this benefit to their employees. And essentially, it's what it is. Businesses that are providing childcare services for your employees, essentially within the business location itself. Paid family medical leave credit under the TCJA that was set to expire at the end of this year. OBA extended it and did enhance it to include a lot more employees, those that are part-time, those that have only been working for 6 months, but it also changed the calculation of how the credit can be calculated to now include insurance premiums. So some small changes to that, but it has been extended and indexed for inflation moving forward. And then the last one, we talked a little bit about this yesterday on the individual side, but for those employers that are paying for student loans under TCJA, you could, again, exclude up to $5,250 from the employee's wages if those payments went directly for qualified student loans, and the business would get a deduction for that. That, again, was set to expire at the end of 2025. OBA made this permanent and adjusted for inflation going forward. So, Carl, I think you're going to hit the next few topics here.
Okay. Oh, good. All right. 1202 stock. Brian said he could spend a half a day on 199. We could spend a full day on the 1202 stock. But the 1202 stock is something that's been there. The current bill has improved the opportunities. But 1202 stock is stock where you have you're one of the originators in a C corporation. It has to be C corporation. You've invested funds. You've acquired stock either by paying cash for the stock, by contributing property, or potentially doing services. So if you were someone that helped them get started and you took shares of stock instead of cash, you would be considered eligible for this. So what happens is that if you hold this stock for at least 3 years, beginning after July 4th of 2025, then you can exclude up to 50% of the gain. If you've held it for 4 years, you can exclude 75, and after 5 years, 100,000. You can exclude up to $10 million of gain on the individual level, and the profit from the business was limited at 50 million, and now it's gone up to 75 million. So this is a great opportunity if you are looking to start up a business. You don't have to make an election when you start up, but knowing that there's an opportunity there, if you start up a business and it grows and appreciates in value, and you sell the stock of the company, you can exclude up to 100% of the gain, up to $10 million of the gain. I don't know if anybody, we've represented 2 of our clients that have gone through this and received the benefit under the old laws. The holding period was a little bit longer, and but it was still extremely beneficial. Last time we did, they did get 100% exclusion of the gain, federal and Maryland as well. Business interest limitation, and this was a bill that went through several years ago where they were looking where you had, and it's mainly not going to be you, but it's going to be an investment that you come into where it's highly leveraged, and they had interest over 30% of the expenses. And what they did is they put a limitation on that. It's still there, but the calculation is a little bit different, where instead of just having income, they are doing what's called the EBITDA calculation, where they add back depreciation and amortization and taxes to do the calculation, which frees a little bit more up. As I said, for most of you that would receive that, it'd be through a K-1, and it's really at the entity level. But hopefully, with a change, more of the interest will be deductible. Excess business losses. That's something that changed over in 23, 24, where if you had losses from Schedule Cs, farms, rental properties, S corporations, partnerships, and they exceeded 500, if you were married filing joint, if they exceeded $500,000, you were limited to taking a $500,000 loss. The balance, so if you had a $600,000 loss from all of those entities, the balance would just carry forward into next year. So the new bill has increased it to 626,000 for married and 313 for single. So again, this would come back into some of the planning that we would do for depreciation, and if we take this bonus depreciation, we're really not going to get it. It's just going to carry forward. So is that something we would look at a 179 or something else to limit that and allow that to carry forward that way? But those are the key changes for those areas.
All right, Byron.
All right, thank you, Brian. So yeah, just some additional business provisions that came about out of the new Tax Act. So one of them is the tip credit got expanded. So for those that are not familiar, the tip credit is a credit that allows eligible employers to claim a tax credit for a portion of the FICA taxes, Social Security and Medicare, associated with eligible employees' tip income or qualified tips. And so the new act did not necessarily change the calculations of the credit, but what it did is it increased the amount of industries associated with it. So prior to the act, the only eligible industries that could take advantage of the tip credit were the food and beverage industry. Now it's expanded to include the beauty and personal care industry. So think about your hairstylists, nail salons, spas, places like that ultimately can now take advantage of the tip credit associated with qualified tips. And that is an important part. It is qualified tips. So I think I brought up the example yesterday, but ultimately, if you're at a restaurant and you have a large party and they do the automatic 18% gratuity, that is not necessarily a qualified tip. It has to be voluntary. So just keeping that in mind when it comes to actually calculating the credit, it's only for qualified tips. And once again, the credit itself did not change. It's just the industries that are eligible for it have now changed.
So Byron, I've seen some verbiage there where some of the restaurants are going to change the 18% mandatory to a voluntary, that we've put that on there, but if you wish to adjust it up or down, you have the right to do that.
Yeah,
So I
that's
think
a good
that's their
point as
way of
well.
getting around this and still making it eligible.
Yep, that is a good point as well. And not, I wouldn't even call it a loophole. It's just another strategy that's at play that could certainly take advantage of it. So, and then the next two items, once again, we did discuss those with the individual section yesterday, but now we want to kind of focus more on how this is going to impact employers. And so, for instance, the respective deduction on tips and overtime. So once again, we can kind of, you can look at the individual section, but at least as it relates to the employer, I had mentioned yesterday that ultimately there's going to be some more administrative work with this as far as it relates to determining what is wage eligibility, the reporting requirements, and really ultimately if you utilize a payroll service provider, getting with them and trying to make sure that you're reporting this, as whether it's on the W-2, whether it's in the individual or quarterly payroll filings, whatever the case may be, there's just going to be some additional tracking in order for these employees and others that they're able to take advantage of those new deductions at play. And then the one thing to kind of keep in mind is that Social Security and Medicare taxes will still apply. This is more so just a deduction at the individual level that they'll really see the benefits. But certainly
Right.
strategies, things like
Yeah,
that. So,
and just remember, this is above the line deduction. They
yeah.
don't have to itemize. So again, with this new play on the importance of AGI with all these other benefits that are out there, this will help.
Yep.
So it's
Just
gonna
another
be the
employee
same- both the
benefit.
tips
Yep.
and the overtime are going to be above the line deductions.
Yep. So, yep, certainly more employee benefits, employee incentives, a way to kind of keep your employees there, especially ones that are directly associated or impacted by, tips, and then certainly overtime as well. And then I went in depth on the Trump accounts, or at least on the surface level as it relates to individuals. But I mentioned yesterday that ultimately employers can also make a contribution on behalf of the employee or the employee's dependent up to $2,500. So in that scenario, if the employee or the employee's dependent wanted to max out the 5,000, they would just make up the additional $2,500. But at the very least, you need to have a written plan in place. That is a key item. So it has to be non-discriminatory, certainly against certain income groups. And so, yeah, at the very least, you have to take that into consideration. So similar with the tips and overtime, just want to make sure that you have plans in place, have your paperwork, administrative actions in place. Prior to establishing these or potentially contributing to these plans. In addition, similar to other non-taxable employee benefits, it does not get treated as compensation to the employee or the employee's gross income. So another incentive at play that ultimately can keep your employees or certainly provide that employee incentive overall. And once again, with all these kind of just providing additional tax strategy, tax planning opportunities as well. And then lastly, it won't really touch too much on it, but the work opportunity tax credit. This was a tax credit that was associated with hiring certain targeted groups that may have difficulties with achieving employment status, your qualified veterans and others. So unfortunately, that would expire at the end of this year, December of 2025, I should say. So.
All right, thank you guys. So just to sort of sum up, the new changes for businesses just provides a lot more certainty when it comes to long-term planning, that we now have some permanent rules that are going to be in place for the next several years. That has made planning very difficult. We have been operating under rules where, like for for instance, bonus depreciation has been going down 20% per year. So now that we know it's 100% and that's permanent going forward, we can now advise clients as to, you know, if there's decisions to be made about what to buy and when to buy. What we will be working with you on, you know, making sure we're maximizing the QBI, your pass-through entity payments, and taking advantage of whatever credits that you're eligible for. And, you know, we do have to keep in mind that there are some aspects that are expiring, so we have to keep those in the back of our minds. But like I said, those won't be for another 3 years at least. So what's next? So again, like we said yesterday, we feel like almost every client will be impacted in some way by OBA. And what we want to do is we want to work with you sooner rather than later, because again, if we wait until October, November, December to look at some of these provisions, it might be too late to act. So especially the ones that have certain income thresholds on your personal return. Because I know for a lot of you that have pass-through entities, what the business does will impact what we're able to do on your personal return. So we will be reaching out in the next few weeks just to offer planning sessions, you know, to schedule a time to sit down with you, go over an overall comprehensive tax plan for you to see how we can take advantage of these new tax changes. And with that being said, Amber, Kieran, any questions from the audience?
Yes, there's a few. One regarding the tip credit, do pooled tips qualify?
Yes, I mean, what's going to happen is the tips, whatever's reported by the employer to the employee, that's going to be included in their income. So that's the key. Whether it's what you directly earn or whether it's a pool that you're sharing with, it's going to show up on the W-2. It's going to show up as tips, and then that amount will be able to deduct as an above the line deduction. So there's going to be, the W-2s are going to have a lot more information than they had historically for the tips and the overtime.
And on, just to add to that, ultimately, I didn't mention it, but there is a little bit of a grace period with making sure all this is kind of comes to fruition. And so at the very least for 2025, the IRS, or at least based on our understanding, is that there'll be a little bit of leniency as far as the administrative side of things, the employer work, all of that. And so, you know, like I said, you can certainly take advantage of that. But yes, those pool tips would certainly be included as well.
Okay, for the employer payment of student loans, can the $5,250 be added as employee reimbursement through payroll, or do you have to make direct payments to the student loan provider?
From what I understand, it can be done either way. So either the employer makes the payment directly, or the employee pays it and then seeks reimbursement from the employer up to the $5,250. You just have to make sure that if you're offering this, that you have a written plan in place to ensure you're meeting all the non-discriminatory rules and the you know, just staying in compliance with the tax code. So yeah, so from my understanding, it can be done either way.
One question was, is there any changes on crypto for personal or corporate?
I haven't seen anything. Have you seen anything, Brian?
There's always something with crypto. Nothing that I remember as being specific to OBA. I do know that there have been some other changes. There's some new bills that were passed after OBA. I'm blanking on actually I have them written down here. Because I have a client, shout out to Ryan. He put me on into the Genius Act and the Clarity Act. Now, those just passed within the last couple weeks. To be honest, I have not read those, but they are related to crypto and some changes coming down the road with crypto. And I believe they refer to or they impact a lot of the brokerage companies and their ability to now include crypto as part of portfolios and some of the reporting requirements on that. But again, I have not read these. I'm not an expert in them. But if you want to look up, again, they're called the Genius Act and the Clarity Act. Those I know are new, extremely new, just passed in the last couple of weeks, that do deal with crypto.
There's a question for the Trump account contributions. When can that start and who qualifies if you don't have any W-2 employees, i.e. family-owned LLC doing real estate rental?
So I can at least answer the first question. So July 4th, 2026 is your first date that you can set up and contribute to a potential Trump account. As far as it relates specifically to that example, I probably have to do a little bit of additional research to determine how that would kind of work out. I think it's mainly just for employees. As far as it relates to the employer contributions of the 2,500 max, but yeah, I'd probably have to look into that a little bit further to determine if there is a potential opportunity for, ones, the employees or employers that have no employees, or specifically like a rental property, LLC, things like that.
So I would just add, so the presentation we did yesterday, we were kicking back and forth the advantages of the Trump retirement plan versus Roths and IRAs and all those other things. And the Trump plan is basically until the child turns 17, there's no income. It's strictly a $5,000 contribution. So you can put $5,000 in. And then when the child turns 18, it essentially switches over to an IRA and is subject to a lot of those same restrictions and guidelines there. You can still take funds out for first-time home buyer and for education, but all that does is eliminates the penalty. You still have to pay tax on it. So I just went in and did like net present value of putting in $5,000 a year for like 16 years, because it can start when the child is a year old, because there's no income level. And so really it becomes an opportunity to fund a retirement plan before there's any income at a very early age. And then by leaving it in there till they reach 59 and a half, which again mirrors exactly what a IRA is, I put in like $80,000 over 5 years, or I'm sorry, over 16 years, and then held it in there for another till they reach 60. And there's about 1.7 million at 6%. So if that's what your goal is for these for funding for a young child, that's what it does. It doesn't replace the Roth, which certainly when they start having wages, you would do the Roth versus continuing to contribute. That's because this is majority of that, or almost all of it's going to be taxable income when they pull it out at that point. So that's the advantage. You don't have to have income. There's a $5,000 max that you can put in. It can come from you. It can come from grandparents, anybody. There's even that it could come from charitable contributions, from going into a charity, donating funds into it, municipalities contributing funds. So all those things are available. But for most of us, it would just be we have a grandchild and we set it up, or you have a young child, you put the funds in and just plan on it being in there for the rest of their life until they turn 60. And that would be it. It's, as I said, it's still available to take out, but it's like any other traditional IRA, that there's going to be penalties before 59 and a half. And income.
Is there anything that you can take advantage towards your 2024 taxes?
Because of the bill? I don't see anything that goes back retroactive.
Well, I guess the only thing would be if you have R&D
Yeah,
expenditures, that can go back to 22. If that's the only thing included in the bill for 2024 that we touched on. I guess if you're talking about just in general, if you haven't filed your 2024 taxes yet, there's not a whole lot out there other than depending on your situation and if you're a business owner or not, maybe making some SEP IRA contributions or other retirement contributions, things of that nature. But if you have questions on that, you haven't filed your 24 taxes yet, please reach out to your tax preparer for more specifics on, what you might still be able to do to reduce your 24 tax liability. All right, is that all the questions for today?
That was all the questions.
Wow, we must have did a lot better today than yesterday because there's a lot of questions yesterday. But like we talked about, in the days that come, if you think of questions that you weren't able to get to today, you know exactly where to reach us. We're always willing to help. And for anyone that I know we got some questions about whether they registered for this event, but were not able to attend for one reason or another, whether or not this is being recorded. And the answer is yes. So both sessions have been recorded, and we will probably at the beginning of next week send out the links to our YouTube channel to where you can watch those on demand. So, feel free to go back and watch it, pass it along to anyone that you think might be interested or might benefit from hearing this conversation. And again, any feedback that you have on the presentation itself or any future presentations or webinars that you would be interested in, please feel free to let us know. We love hearing the feedback from you guys so that we can continue to do these for you, educate you, and so that you have a better understanding of your personal tax situation, your business tax situation, and just provide a better relationship between ourselves and you, our client. So again, we thank you very much for taking the time today, and we will talk to you guys soon.